You know, you thought that silver could go to 50. It didn't. It's 75. There's a parabolic up chart. 50% of the money went into silver stocks. Why silver stocks, not silver? Here it becomes arithmetic. If the silver price goes up, the silver stocks do well. Gold will trade inversely to faith in the US dollar. Faith in the US dollar, because of nominal interest rates, is relatively high now. But the arithmetic around the US dollar is profoundly bad. I believe specifically the dollar will likely lose 75% of its purchasing power.
For someone who kind of only thinks about gold, make the big picture case, right? Why copper, why now?
My suspicion is that US interest rates will stay nominally strong and gold will be nominally weak, perhaps for the balance of 2026. But that doesn't matter. Structurally, the dollar's toast, not relative to the Canadian dollar, not relative to the euro. But
Hong Kong launched its own gold clearing system, right? Singapore's building one. Even London shifted into Asian hours, which is interesting. So the East isn't buying the metal right now. It's building the machinery. So what are your thoughts on the Western investor? Now, right now, I mean, we just had, I think of Adrian Day just coming on the show. And I mean, he was buying some haircuts last week and he goes, oh, maybe I should have waited, but it's fine. So that long-term thesis is still there. Is this a buying opportunity now?
Absolutely.
Yeah.
Could it go lower? Yeah. Of course.
Yeah.
Bernard Baruch famously said, the only guy who bought at the bottom and sold at the top was a liar. It didn't happen.
We could talk about your own money because I think we talked about this at PDAC, but you made that big move. I mean, earlier this year, you sold something like 80% of your physical silver. You rotated into silver mining companies. Walk people through that process and whether it played out as you hoped.
The process went like this. I save in gold. Gold is not a speculative asset for me. It's a savings asset. Yes, I would sell it in the right circumstance, but we aren't close to that circumstance. Silver was different. It was a speculative asset. I bought physical silver because silver was hated. And I know that the easy money in cyclical businesses occurs if you have the guts to buy hate. When I bought silver, it was less than 20 bucks an ounce, and people hated it. And my thesis was that over time, that hatred would dissipate and the price of silver would rise. Well, that happened. Mm-hmm. And when it happened, I needed to decide if there was a new thesis that should keep me in silver or whether I should transfer my speculative capital from silver to something else. When I looked at it, I said, you know, you thought that silver could go to 50. It didn't. It's 75. There's a parabolic up chart.
Markets celebrate soaring prices, yet history shows the biggest gains often tempt investors into their worst decisions. Rick Rule notes that buying hated assets is only half the strategy, because disciplined capital rotation matters just as much once sentiment flips. Most retail investors mistake rising prices for reduced risk when the opposite is frequently true. Protecting wealth sometimes means selling strength instead of chasing momentum. Next, Rick Rule exposes why expensive silver may still create opportunity where most investors refuse to look.
You need to sell parabolic up charts because they resolve to the downside. Is there a better use of capital? Yes. 50% of the money went into silver stocks. Why silver stocks, not silver? Here it becomes arithmetic. If the silver price goes up, the silver stocks do well. If the silver trades sideways, by definition, you make no money. But the silver stocks were priced discounting $35 silver in a $75 market. So the silver price could fall and the silver stocks could still do well. If the silver price fell because of the discount in the silver stocks, arithmetically, the silver stocks would fall less than the silver. Same upside, better sideways, better downside. Better speculation.
Now, you talked about gold is kind of a savings, and the gold miners still look cheap relative to the metal, obviously. But are you making the same move now in gold? I mean, are you selling a little bit of metal to buy the miners, or is that just a completely different call?
For me, I save in gold. And despite the fact that I don't need to, I save a lot. It helps me sleep nights and stay calm. All of the net profit from this conference will be invested in physical gold in my account. Placed, by the way, in Battle Bank. I save in gold. I maintain liquidity in US dollars. I invest in senior gold stocks and I speculate in junior gold stocks. Those are very different buckets.
Now, I know Battle Bank is here this year. I went and had a nice little conversation. You're getting closer and closer. People are getting excited about it. Is this kind of the next phase for you? I mean, you've been waiting for this for a while.
Owning more of the right asset can matter far less than owning the right type of exposure. According to Rick Rule, Separating savings from speculation creates discipline that most investors abandon during bull markets. Wall Street often treats every precious metals investment as identical, but valuation gaps can dramatically alter risk and reward. Savers who ignore those distinctions may unknowingly increase portfolio volatility instead of reducing it. Next, Rick Rule reveals why his definition of financial security differs sharply from conventional investment advice.
Well, this is my seventh bank. Many people might know that. It's my second bank in the same incarnation, of the same management team. Okay. So I'm hugely excited about it because I love banking. And I believe in community banks. Battle Bank is a community bank where community is defined by aspiration rather than by geography. Battle Bank is a bank designed around a community that you see here. It makes perfect sense that I would be involved in a bank for this community simply because I know my customer, and my customer acquisition cost is zero. I have a durable competitive advantage serving an audience that I've served for 50 years. And banking is a very good business if you don't make mistakes.
Difficult to get into.
All businesses are difficult. Yeah. I've been in a lot of businesses in my life. Yeah. I've been successful at most of them, but every business is difficult.
Now, you've described gold as kind of being in roughly, the third inning of a 9-inning kind of game. After this correction we just went through, where are we right now?
I think we're in the sixth inning. I believe the gold bull market, at least for me, the gold bull market began in the year 2000. I think we've got 10 years left. Yeah. So we're in the sixth inning. Understand that in most financial markets, the best part of the move, the hyperbolic move, comes towards the end. I believe specifically, getting the baseball analogy aside, that gold will trade inversely to faith in the US dollar. Faith in the US dollar, because of nominal interest rates, is relatively high now. But the arithmetic around the US dollar is profoundly bad. I believe specifically, and I said this the last time you and I interviewed, that the dollar will likely lose 75% of its purchasing power over 10 years, which suggests that the gold price in nominal terms, US dollar quoted terms, could be a triple over 10 years.
The strongest currency narrative often appears just before confidence quietly begins to erode. What Rick Rule is highlighting is that nominal interest rates can temporarily disguise deeper structural weakness without fixing it. If purchasing power steadily declines while investors focus only on headline yields, wealth erosion becomes almost invisible. That disconnect matters far more than short-term price swings in gold. Next, Rick Rule unravels why institutional confidence in the dollar may be far weaker than official messaging suggests.
Not a bad move.
No, it's not. And it's not just gold and silver for you anymore, obviously. You've been putting real money into copper as well, and I want to talk about that because for someone who kind of only thinks about gold, make the big picture case, right? Why copper? Why now?
Well, copper is simple supply and demand. First of all, right now, we're using more copper than we produce. And you can only use more copper than you produce when you have surplus inventories. We're about 3 years away from being out of inventories. That's the way it works. At Metals Week in London last year, they presented a fantastic paper saying that to maintain current levels of copper production, understanding that they're in deficit, to maintain current levels, the 10 largest copper mining companies in the world have to invest $250 billion. Several problems with that. The first is they don't have the money.
Yeah.
Yes, they can get it, but they don't have the money. The second is that you're maintaining production in an industry that's in deficit. The third problem is that copper demand is growing. So the deficit, assuming that you maintain production, is going to fall. The money that we need to invest in copper now, in order to impact copper supply 5 years from now, needs to have been invested 15 years ago. You cannot make up for 20 or 30 years of systemic underinvestment in 5 years. Absent a depression, copper will be rationed by price.
Right. You know, it's interesting. I turned on, just before coming down here, I think I turned on CNBC, at one point Bloomberg, just to see what the mainstream was talking about. And we got this NVIDIA crack right now with the AI trade. I mean, it shredded about $1 trillion since May.
Commodity shortages usually begin long before prices convince investors they exist. Rick Rule's argument suggests that decades of underinvestment cannot be solved with late cycle capital once inventories disappear. headlines remain obsessed with AI valuations, while the physical resources supporting global infrastructure receive far less attention. Investors ignoring supply constraints may be focusing on the wrong side of the equation. Next, Rick Rule reveals why copper's biggest catalyst has little to do with technology headlines.
And now people are going, oh, maybe that's going to affect copper. Maybe there won't be a bullish trend. Is that the contrarian take that you kind of look for?
It's misinformed.
Yeah.
The baseline trend in copper is demographic. There are more people being born every day than are dying. There's more people on Earth. And the people on Earth, particularly in emerging and frontier markets, want to live like you do. A materially abundant life is an energy-intensive life. There's 1 billion people on this planet today that have no access to primary electricity. In 20 years, they're going to. It's going to take copper to generate that power. It's going to take copper to get that power to them. It's going to take copper for them to use it. Yes, AI is going to work. People ask me here at the conference, well, what do you think of NVIDIA? The truth is, I don't think of it at all. I can't spell it. I understand copper. I understand that there's been 30 years of underinvestment in copper. I don't have the sophistication to talk AI. And by the way, most of the people who invest in it don't either.
Yeah.
I'm not panning it. I'm just trying to say that the copper market is easier to understand than the AI market.
But I mean, you're looking more at any oil and gas companies right now? I mean,
Not as a consequence of this. I don't make decisions based on information that I can't process. I don't know what's going to happen in terms of peace or war. I am making oil investments because, as you and I discussed before, the industry is underinvesting in sustaining capital by $1 billion a day. The shortage that we experience today is artificial. It's due to war. It can be ended with an armistice. The shortage that's coming to us in 3 years is structural.
Today's market obsession could become tomorrow's biggest analytical blind spot. This is where Rick Rule's thesis shifts from headline-driven investing toward long-term supply mathematics that cannot be reversed overnight. Demographics and chronic underinvestment move far slower than market sentiment, yet they often determine future pricing. Investors chasing daily narratives risk overlooking structural shortages already developing beneath the surface. Next, Rick Rule exposes why temporary commodity weakness may actually strengthen the long-term bullish case.
And you won't be able to end it with an armistice.
Yeah. Does it ever surprise you, Rick? I mean, these headlines that we see, they act as such a volatile trigger for not only equities, but I mean, oil pricing, et cetera. I mean, ironically, gold sold off today because higher oil revives the inflation fear. And now the markets are pricing in this Fed rate hike, right? Some banks have even come out today and trimmed their forecast on gold. I mean, is this just the breather inside the bigger bull market? And do you think we're going to have a little...
I can't tell you what the market's going to do in the near term. My suspicion, and by the way, I don't invest based on my suspicions, but my suspicion, since you asked me, is that U.S. interest rates will stay nominally strong and gold will be nominally weak, perhaps for the balance of 2026. But that doesn't matter. Structurally, the dollar's toast. Not relative to the Canadian dollar, not relative to the euro, but in an absolute sense, structurally the dollar's toast. So I'm sort of unconcerned about what happens in 2026. I got plenty of money to get me through 2026. I'm vitally concerned about what happens over the next decade.
Yeah.
As to news, I have found that too many people rely on news because it allows them to feel as opposed to think. It's easier to feel. It's easier to have your motivation be something that doesn't require you to do any work. Mercifully in my life, by the time I was 30, I learned that that was the wrong way to invest. And so I get to compete with people who handicap themselves.
That's interesting. That's interesting. And I mean, the investors on the ground at this conference, they do understand. I mean, they learn amazing things on stage here. I watched a couple of panels.
Markets react within minutes, but currency debasement unfolds over years without ringing any alarm bells. Rick Rule notes that short-term volatility distracts investors from structural trends that ultimately shape purchasing power. Financial headlines reward emotional reactions, while disciplined capital quietly positions for longer cycles. Those who confuse daily price moves with lasting value often become liquidity for more patient investors. Next, Rick Rule reveals the overlooked habits separating resilient investors from those trapped by constant news cycles.
And I have to ask you, because it's something that struck me this week, is Hong Kong launched its own gold clearing system, right? Singapore's building one. Even London shifted into Asian hours, which is interesting. So the East isn't buying the metal right now; it's building the machinery. So, what are your thoughts on the Western investor? Just talking to the people on the room here, is there going to be more general?
This is the wrong constituency because you're trying to extrapolate. As I say, you're asking the choir in an evangelical church if they believe in God. Likely the answer is yes. Looking at it bigger, let's look at arithmetic. The market share of precious metals and precious metals related investments relative to other savings and investment classes in the United States is 0.5%. We are as relevant to the broad economy as a pimple is to a blue whale, right. Okay? The 4-decade mean is 2%. If demand returned to mean, it would grow fourfold. In circumstances like this, reversion to mean almost always means an overshoot. But let's assume we don't get an overshoot. If demand returned to mean, if the market share of precious metals and precious metals investing in a market, the United States, that accommodates 22% of the world's savings and investment assets, were to return to mean, demand would grow fourfold.
You know, you always get a comment or two about the contrarian calls. And I mean, you've had some big contrarian voices all throughout this week. So where do you personally kind of draw the line between a contrarian warning that's genuinely worth hearing and, somebody that you think is maybe their thesis would never put your own money behind?
It depends on who you are. A hate buyer, which is the true contrarian, is opportunistic. Right now, nothing is hated.
Institutions rarely build financial infrastructure before they expect demand to increase. According to Rick Rule, the real story isn't today's buying activity, but how little capital precious metals still represent within investor portfolios. Markets often normalize allocation only after prices have already moved substantially higher. Waiting for mainstream enthusiasm has historically meant paying much more for the same protection. Next, Rick Rule reveals why today's tiny allocation to precious metals could become tomorrow's biggest institutional scramble.
So there's no easy money in this market. The easy money is buying hate. There are structural advantages. Copper will be higher in nominal prices and higher in real prices 5 years from now, absent a depression. Guaranteed. No hate, no easy money, but certain money. Demand for uranium over the next 10 years is structurally higher. No hate, easy money's been made, the certain money is ahead of us. For people who are fully invested in natural resources, they can afford not to buy. They can become opportunistic. They can wait for things to be hated. They can wait for a panic. For people who have 0.5% of their net worth in gold and 99% in US dollars, where the purchasing power of their US dollars is almost certain to decline by 75%, they can't wait.
Yeah. That 75% number just keeps coming back. It's an interesting one. And you've always said that in this business, you're either a victim or a contrarian, as you know. So turn it on our crowd. A lot of general investors watching as well. What's the one thing that this entire gold room believes right now that you think may be flat wrong?
There's a huge difference between inevitable, which is my thesis, and imminent. Many people are strategically correct and tactically wrong. If you're investing in a thesis that'll take 3 years or 4 years or 5 years or 10 years to play out, and you have trauma holding stock over a long weekend, you aren't going to have the courage of your convictions. The second thing is that most investors, including those here, don't work hard enough. It's one thing having a belief. It's another thing understanding enough about your investments that you understand the delta between price and value, and that you have enough confidence in your investment that in the inevitable perturbations, simply from volatility, you don't get shaken out.
Being early feels uncomfortable, but confusing timing with being wrong has destroyed countless portfolios. What Rick Rule is highlighting is that conviction only matters when volatility tests it. Financial media celebrates certainty, yet successful long-term investing usually demands patience while narratives temporarily move against you. investors who never distinguish value from price often sell just before their thesis begins working. Next, Rick Rule unravels why emotional investing quietly transfers wealth to disciplined capital.
You know, there's a lot of people that are live streaming. They're wanting to kind of attend. They're learning more and more. I mean, last one, out of everything on this floor this week, I mean, what's the one thing that you kind of hope that every single person walks out of here actually understanding?
Two things, I'm afraid. The first is that their understanding of inflation is wrong. Americans, even intelligent, learned Americans, believe that a deterioration in the purchasing power of their dollar is measured by the CPI. There's a wonderful phrase that the CPI is the CP lie. I would invite any of your listeners to informally construct a basket of goods and services that their family consumes. Look at the prices that they paid for that basket of goods and services in 2020 and the price that they pay today. The government will tell you that the dollar is losing its purchasing power to the extent of 2.5% a year. The real number for your family is 8. And juxtaposing that 8 to 2.5 should be the fundamental that people use to plan for their future. That's the first thing. The second thing is that there has been structural underinvestment in the means of production for a very long time. That doesn't mean that technology isn't a good place to invest, but you have to understand technology. If you understand a whole bunch about chips and semiconductors and servers, you can invest in NVIDIA. But if you're like me and you can't pronounce it, you can't invest in it. So that's what I would urge people to do. I would urge people to look at the fact that there's been structural underinvestment in extractive industries for 30 years while the economy has grown. And the simple balance of supply and demand means that the stuff of humankind, which gets more used as there are more people, the stuff of humankind is going to be rationed by price.
Nobody wants to stop consuming.
Official inflation numbers matter far less than the prices quietly draining your own household budget. Rick Rule's argument suggests investors should measure purchasing power using real-life expenses instead of government averages alone. The same gap appears in commodity markets, where years of underinvestment remain largely ignored despite rising global demand. Protecting wealth starts by questioning comfortable narratives before markets force that reassessment.